In 2001, the unemployment rate rose by 0.5% in just 6 months, leading to the dot-com bubble. In 2008, the unemployment rate also rose by 0.5% in just 6 months, leading to the financial crisis 2008. Today, in 2025, we also see the unemployment rate rise up by 0.5% in a short amount of time, leading to the current unemployment rate of 4.2%. History is showing us that this increase of the unemployment rate was closely before or during a recession, which leads to the belief that the same might be happening again this time. And this of course would also have a major impact on the stock market, but the unemployment rate is not the only indicator which is currently flashing red. Another important indicator is the yield curve, especially when the chart is starting to show an inverted yield curve as it is doing now. The yield curve is inverted when the short-term interest rates are higher than long-term rates. So the inverted yield curve is unusual and often seen as signal for an economic recession ahead. As history also shows, the yield curve always started to invert shortly before or during a recession. Also, in comparison to the chart of the real GDP growth, we can see the interconnected dots that the yield curve inverted before slowing GDP growth or even declining GDP rates happened. Let's have a look at the next indicator, the overall debt. Consumer debt is at an all-time high with $20 trillion, and as you can see, it was never that high in the modern human history, not even in the past recessions. This is a problem as with higher debt, the households have less disposable income to spend on goods and services due to high interest payments or debt repayments. And reduced consumer spending, which is a significant driver of the GDP, will slow the economic growth. Government debt is at an all-time high with $36 trillion. Same thing here, was not even close that high in the past or during past recessions. High government debt can limit a country's ability to stimulate the economy during downturns. And with higher interest rates, servicing debt will be even more difficult. That could require tax increases or spending cuts, which will then further strain the economy. Corporate debt is at an all-time high with $13 trillion, with a tremendous increase since 2011 of over 100%. Companies with high levels of debt are vulnerable to economic slowdowns, rising interest rates or reduced revenue. These factors can lead to reduced investments, layoffs, or they can even go bankrupt. This can lead to a ripple effect with the other indicators. And finally, we can check where the Buffett Indicator is currently sitting at, and it's sitting at an all-time high with an overvaluation of 205%. In the past it was always elevated before crash, but never as overvalued as it is today. But this is also no surprise as the cheap money flooded all asset classes in the past few years. Smart money is behaving cautious in these times, as they hold more cash nowadays as ever before. Do they know something and prepare for setbacks? Let me know in the comments. Thanks for watching.